Looking for dividend aristocrats with high yields that give you an instant high dividend income? In today's video I will reveal 5 dividend aristocrats which have a yield higher than 4% with a relatively high dividend safety, and some even offer a good combination of a current high yield and a good dividend growth rate. Hi and welcome back to the Dividend Attitude. Before we start I have to give a fair warning. Don't chase high yield, you can get burned. They are usually high for a reason. So always look beyond the high yield to find out if it is a quality company. Most of the dividend aristocrats mentioned all have some risks and uncertainties involved, so it is up to you to determine if you think it is worth it. Today there will be no portfolio update. I will be experimenting with less frequent but more in-depth portfolio updates. AbbVie is a biopharmaceutical company that was spun off from Abbott Laboratories, ABT, in 2013 as a standalone company. Although technically AbbVie is not a dividend aristocrat, it is considered a dividend aristocrat by many, adjusting for its spin-off from Abbott Labs. The story of AbbVie is that of a biopharm company that is heavily reliant on one blockbuster drug, Humira, approximately 70% of its profits, which will lose exclusivity rights in the US in 2023. In that light, they have acquired Allergen to further diversify their income streams. AbbVie is part of the healthcare sector. As a standalone company, AbbVie has been raising its dividend for 8 years now with a 45.2% earnings payout ratio and a free cash flow payout ratio of 49.3%. The earnings payout ratio trend is looking good because it has been consistently hovering around the 45 to 50% mark. As a standalone company, AbbVie has not yet been raising their dividends for 10 years, so there is no 10-year growth rate to show. But the 1, 3 and 5-year growth rates are all around 20%. AbbVie offers an interesting mix of high yield, 4.89%, and high dividend growth. But as you will see, that high yield is the reflection of quite some risks. Mainly around the question if AbbVie can diversify enough to offset the loss in sales from its Humira drug in the future. The Simply Safe dividend score stands at 50 and was downgraded in 2019 to borderline safe after the Allergen acquisition. According to the Simply Safe Dividends website, this has mainly to do with increased debt on the balance sheet, which puts further strain on their balance sheet. So the big question is if AbbVie will do what they should do, which is to pay down their debt aggressively. AbbVie managed to grow its revenue from 15.6 billion in 2010, this was pre-spin-off, to 33.3 billion in 2019 for a nice 8.9% revenue growth rate. The revenue growth was only 1.57% in 2019 though, so that is something to keep an eye on when they present their sales numbers in the coming quarters. There are no free cash flow figures from 2010, but the free cash flow per share in 2019 was $8.69. As you can see in the free cash flow graph, the free cash flow dipped in 2016 but went straight up after. And then the debt, so how bad is it? In 2012 the debt to equity was already very high at 4.35, and in 2017 it was even higher at 6.07. In recent years there is no debt to equity because the shareholders' equity actually went negative. So again, the big question will be if AbbVie will do what it set out to do. In the earnings conference call of Q1 2020, Robert Michael, CFO at AbbVie, stated that we have committed to paying down 15 billion to 18 billion of combined company debt by the end of 2021, of which nearly 7 billion will be repaid by the end of May 2020. The credit rating of AbbVie is Baa2 on Moody's and is still investment grade. There is no return on equity for AbbVie in 2018 and 2019, since their equity is negative, more liabilities than assets. If we compare that to the 70% return on equity of competitor Amgen, then it doesn't look that good. On the other hand, the 23% return on invested capital looks slightly better than the 19.3% of Amgen. The operating margin of AbbVie stands at 40% in 2019 and is on the high end of their 10-year average operating margin. The operating margin of Amgen is in line with AbbVie's operating margin at 41.3%. If you liked the video so far, don't forget to like the video and subscribe to my channel. I've said it many times already, but this positive feedback is much appreciated. Consolidated Edison is a regulated electric and gas utility in the New York metro area. As a regulated utility, Consolidated Edison benefits from what is known as revenue decoupling mechanisms. Decoupling ensures that revenue earned by utilities is in line with what they need to cover costs and earn a fair return. With decoupling plans, the rates change with consumption to meet predetermined revenue targets. 87% of their business falls under these regulatory policies. Con Edison is divided up into 4 business segments. Consolidated Edison of New York, Orange and Rockland, Consolidated Edison Clean Energy Business, and Consolidated Edison Transmission. Consolidated Edison has been raising its dividend for 46 years in a row now. With an earnings payout ratio of 71.6%, they would be above my target payout ratio of 70%. However, Edison is a regulated utility, meaning that they have a protected and stable income stream, which also means that these utilities should be looked at differently, and 71.6% is still a decent payout ratio for such a stable business. As discussed before in the episode of 5 safe dividend stocks, now suggested in the top right corner, free cash flow is usually negative for utilities. This is due to large capital spending, which is often funded with debt and equity. Thus, the free cash flow payout ratio is not a good way to measure the payout ratio of a utility. The dividend growth rate of Con Edison is typical for a utility and is around 2.5% to 3.5% over a 1, 3, 5 and 10 year time period. The purpose of having a utility in your portfolio is usually not for fast growth, with some exceptions like Nexera, but for a dividend safety during recessions and diversification. With a current yield of around 4.2%, Consolidated Edison would give you a nice instant dividend income stream. With aforementioned regulatory policies in place to protect the earnings of Consolidated Edison, a healthy payout ratio for utilities and a growth streak of 47 years, the Simply Safe dividend score is 90. The revenue of ED went from 13.3 billion in 2010 to 12.5 billion in 2019, for a decline of 0.6%. Normally not a good sign. But like I mentioned before, the revenue is protected by the revenue decoupling plans. Like I also mentioned before, free cash flow is not a very useful metric to look at for utilities. The debt to equity went from 0.95 to 1.07, which would be higher than my threshold of 0.5, but for such a capital intensive and predictable business model, that is fine. Compared to other utilities like Southern Company with 1.58, Dominion Energy at 1.14, it is on the lower end. The credit rating of Con Edison is Baa2 for 2019. The return on equity is 7.7% and is capped to 9% because they are a regulated utility, and regulators want to keep the energy prices at reasonable levels for consumers. Therefore, it makes no sense to compare it to competitors. The same applies to return on invested capital, which is at 5.6% for 2019. The operating margin stands at 21.3%, which is lower than the 24.9% of Southern and the 23.5% of Dominion. Due to the current health crisis, demand for power has been lower due to many people working from home, so this has some effect on the revenue stream of Consolidated Edison. I don't think Realty Income needs much introduction as it is a favorite holding among many. Realty Income is a REIT that mostly leases out their properties to non-discretionary retailers, which is 83% of their rental revenue. All of Realty's income properties have long-term triple net lease contracts, meaning that they offer stable cash flow to the company, and triple net means that the operating expenses such as maintenance, utilities, insurance and taxes are all responsibility of the tenant. Some of their top tenants include Walgreens, CVS, Dollar General, AMC Theaters, Walmart, Sam's Club. Realty Income became a dividend aristocrat last year and has now raised its dividend for 26 years in a row. For REITs, it is not useful to look at the earnings payout ratio, but rather to look at the adjusted funds from operations, or AFFO payout ratio. The 85% we see here is the adjusted funds from operations payout ratio. This is a bit on the high side for REITs, but still within the limits. The 10-year dividend growth rate is almost 5%, but the 1-year growth rate is more towards 3%. So the dividend growth rate is not exciting, but like utilities, they provide a reliable stream of dividend income. With a current yield of 4.7%, Realty Income can still give you a nice dividend income stream. The dividend safety score of Realty Income currently stands at 70 and was downgraded in the light of the current health crisis. Their revenue went from 0.35 billion in 2010 to 1.5 billion in 2019 for an astonishing growth rate of 18.6%. For REITs, adjusted funds from operations is a more meaningful metric than free cash flow. The AFFO went from 1.86 in 2010 to 3.32 in 2019, all this time nicely covering the dividend. The debt to equity actually decreased from 1.06 to 0.82, although this is mainly due to an increased shareholders' equity. Realty Income has a credit rating of A3. This is important because it enables them to keep their cost of capital low. They can lend money cheaper because there is less risk for the lender. The return on equity for Realty Income is 4.9%, which is well below my 10% threshold, but around average compared to its own 10-year average. The return on equity of a fellow REIT like Simon Property Group is 73%, which is significantly higher, but their debt to equity is also much higher than Realty Income. The return on invested capital for Realty Income is 4.4%, which is on the lower end of the 10-year average. Again, it is lower than the almost 11% of Simon Property. The operating margin of Realty Income is almost 50%, which is just a tad lower than the 50.5% of Simon Property. Probably this is a well-known fact, but Realty Income pays monthly dividends. They even named themselves the monthly dividend company. Walgreens Boots Alliance is one of the largest pharmacy retailers and drug distributors in the world, with over 18,000 pharmacy stores around the world. They operate several brands, such as Rite Aid, Walgreens, John Reed, and Boots. Walgreens has three business segments: Retail Pharmacy USA, Retail Pharmacy International, Pharmaceutical Wholesale. Walgreens has been raising its dividend for 45 years now and has an earnings payout ratio of 33.5% and a free cash flow payout ratio of 38%. Walgreens has a great 10-year growth rate of 13.6%. The dividend growth has come down to a bit under 7% in recent years, but with a current yield of 4.3%, there's an excellent combination of yield and dividend growth. The dividend safety score is currently 70, which reflects the uncertainty still ahead of us during this health crisis. Although Walgreens was allowed to stay open as they are deemed as essential services, it has had an impact on their revenue streams. Their revenue has grown from $67.4 billion to $136 billion for a growth rate of 8.6%. The free cash flow per share has risen from $2.76 in 2010 to $4.76 per share in 2019. All this time while covering the dividend, as you can see in the graph below. One of my favorite things, a company with low debt. Walgreens had a debt-to-equity ratio of 0.17 in 2010 and now has a debt-to-equity ratio of 0.47 in 2019. The credit rating on Moody's stands at Baa2. Return on equity for Walgreens is 16%, which is at the midpoint of the last 10 years. Compared to a competitor like CVS, which I have shares of, with a return on equity of 10.8%, they are doing well. The return on invested capital stands at 9.9% and is a bit on the lower end of the 10-year average, but is still a lot higher than the 6.2% of CVS. Just like with many retail stores, the margins are razor thin and the operating margin of 3.5% in 2019 is the lowest it has been in 10 years. CVS has a slightly higher operating margin of 4.7%. AT&T must be one of the most discussed dividend growth stocks in the dividend investing community. AT&T is a telecom and media giant which operates in four business segments: communications, Warner Media, Latin America, Xander. Whereas the communications segment is about 77% of the total revenue. AT&T has been raising its dividend for 36 years in a row now and has an earnings payout ratio of 64.8% and a free cash flow payout ratio of 51.8%, so the free cash flow payout ratio is quite reasonable indeed. If you are looking for fast dividend growth, AT&T is not for you. It is raising its dividend at the rate of a utility with 1, 3, 5 and 10-year dividend growth rate at all around 2%. AT&T does have a current yield of almost 7% though, so that would give you a lot of instant passive income, and this is what draws most investors to AT&T. The dividend safety of AT&T is currently 65 and has recently been upgraded mainly due to the 3-year capital allocation plan they communicated at the end of 2019, which includes aggressively paying down debt, no big acquisitions and a continued focus on paying dividends. AT&T revenue grew from already an astonishing $124.3 billion in 2010 to $184.2 billion in 2019 for an average growth rate of 4.4%. The free cash flow of AT&T went from 2.6 in 2010 to 3.96 in 2019, while covering the dividend all this time. When talking about AT&T, one topic always comes up: their massive debt load. On a debt-to-equity ratio it does not show that much because the debt-to-equity ratio was 0.53 in 2010 and is now 0.94 in 2019, so that is definitely not that much worse than some other companies. That's because they are a massive company with massive assets as well, over $551 billion in assets, more assets than Amazon and Google combined. Looking at the long-term debt, it was $149 billion in 2019, so that is a huge pile of money. To give you an idea, that is more than the GDP of some countries like Hungary, Kuwait or Cuba. Like I mentioned in the introduction though, they are determined to pay it down aggressively. The credit rating of AT&T is Baa2, which is still well within investment grade. The return on equity was 7.6% in 2019, which is on the low end of their 10-year average. On the communications front, the biggest competitor is Verizon. which has a return on equity of 33.6%, so absolutely crushing AT&T on that front. Return on invested capital was also on the lower end of their 10-year average with 5.7%. Verizon has a return on invested capital of 12.9%, so also higher than AT&T here. Operating margin in 2019 was 16.2% and on the higher end of the 10-year average. Verizon at 23.1% is again higher than that of AT&T. If you liked the video and would like to get updated on when a future video comes out, please like the video and subscribe to my channel. It will greatly help my channel grow further and get my content out to more people. If you haven't done so, be sure to check out my playlist on how to find and research different stocks. People have let me know they find great value in those. You can click on the playlist in the top right corner. Do you like these quick overview videos of dividend aristocrats? Let me know in the comments below. Until next time, bye bye!